Mohamed, I'm sure we can say striptease and central bankers in the same sentence. We just don't want to envision it. But Mohamed, everyone's saying $1.2 trillion. Is that going to be enough?
Well, it depends what your objective is. So is it large? Yes. Is it open-ended? No. Is it unambiguous? We don't know yet because it depends how they pool the risk. I think, Betty, the key issue here is what is the objective? If the objective is to restore economic growth and break the expectations of deflation, the ECB cannot do that on its own. If it's an intermediate objective of weakening the currency further, keeping interest rates relatively low, and minimizing the differentiation among member countries, yes, it can do that. The question is at what cost? So I think it's really important to ask the question, what is it that we want the ECB to do? Is it a financial outcome or is it an economic outcome? And there's a huge difference in terms of its ability to deliver.
Well, speaking about the financial outcome, though, Mohamed, I want to bring up this chart. You can't see this, but our viewers can. Let's bring up the German one-year yield, which Mohamed, just a few days ago, went negative. Okay, it's now at negative 0.1%. So you are actually paying. You're losing your money, right? You're paying the government to hold your money. This is not just happening in Germany, by the way, Mohamed. It's happening in Switzerland as well. So, has this momentum, when you think the impossible has happened, now you're seeing negative yields on your government debt. When that happens, is it too little, too late?
So that is the problem of the lower bound, as the economists call it, is when you get to zero and you go negative, strange things start to happen. Look at Switzerland, where now banks are going to charge you to keep your money there, right? And that's
Incredible.
A very strange world we're living in. And that's simply because we are relying too much on central banks and other parts of the policy-making apparatus. These other parts are not responding.
Mohamed, hang on. I want to bring back Hans. We fixed his mic. Hans, you were talking a little bit about the program that is likely to be announced. Tell me, though, about some of the dissent. Are you hearing any, even anonymously, some dissent here within the ECB on quantitative easing?
No. I mean, in some ways, it's more important that it's public, right? It's very public from the Germans that they don't support quantitative easing. They're just two radically divergent views on what's causing inflation or deflation. The Germans want to wait to see what happens when you see the price of oil. So the difference between headline and core inflation. They think the low price of oil is going to stimulate the economy, and they want to have a few more months of data on that. It's been remarkable in some ways how public it's been, right? Angela Merkel with Mr. Draghi in the audience earlier this week, kind of laying out her parameters for what a central bank should do. You have Jens Weidmann, the Bundesbank president, very critical. You have Sabine Lautenschläger. She is on the executive board, very critical. I mean, I think a lot of us are going to be looking at a lot of things when we actually get the news conference here in a little bit. Top among my list is how many dissents there are. If this is indeed unanimous, and we'll be able to find that out pretty quickly, if it is indeed unanimous, that may mean it's pretty circumscribed and it hews to the German view of what quantitative easing is, and that means national banks may carry some of the risks. It will be very tightly targeted, and you won't have any debt from either Greece or Cyprus. Betty?
Mohamed, that raises a good point. How do you think the governments will respond to a bond buying program?
So if they allocate the risk down to the national banks, a couple of things will happen. First, it will not be as powerful as if they pool risk. And second, as Hans just said, it will be clear that now political compromises are dictating the design of the policy response. And markets will react negatively to both these things.
Ray Dalio at Davos, he was on a Bloomberg panel, the head of Bridgewater Associates. He said to us, look, you've gotten to a point where it's no longer interest rates, but the currency that is the big lever for the government. I want to play for both of you, Hans and Mohamed, what Ray Dalio said. I want to get your reaction.
We see this ECB policy. It needs to have more money into the system. Money can produce more purchases. It also means that when the two levers are interest rates and currency, it means when interest rate lever doesn't work, currency lever becomes more effective. So we necessarily must see more volatility in currencies. We must see a depreciation further in the euro.
And possibly a further currency war, Mohamed. What does that mean, not just for the euro, but for other assets, including the dollar?
So I agree with him completely that this is now about the currency. And you've heard me say this before, Betty. Be careful of what history tells us. And what history tells us is when you get very large movements in the major currencies, that tends to break things. We've already seen what's happened in Switzerland. We see the pressure under which Denmark is under. Right. We see what's happening in the emerging world. So, yes, the focus is now the currency, but you cannot expect the currency markets to do all the heavy lifting. Because if you expect them to do that, then something will break in the system.
But what about the U.S. having to do the heavy lifting now, Mohamed?
So the U.S. is the one country that's not opposing the appreciation of its currency. And that's because we are in a far better position than Europe or Japan find themselves in. So we are going along, but already you're seeing companies starting to warn that this is not helpful for their profits. Now, the good thing is we're getting a positive shock in terms of lower oil prices, so you're not going to get a political reaction anytime soon, but it is the U.S. that is carrying the burden of the appreciating currency.
But is that carriage going to eventually collapse, though, Mohamed? I mean, how long can we sort of become the super economy for the world? I mean, at some point, are we going to get hit by not just the crisis brewing that is in Europe, but also what's going on in Japan and with China slowing down and other emerging markets getting hit by oil?
So that is the big question, is, can we decouple? Can we continue to decouple? Can this world of divergence continue in which both economic performance and monetary policy go in different directions? And honestly, Betty, no one knows the answer to that. My own guess is that it will put so much stress in the system that one of two things are going to happen. Either we get the correct policy response around the world, and then we unleash a massive upside, because don't forget, there's a lot of cash on the sideline. Or alternatively, currency starts behaving very erratically, and that causes so much financial market volatility that it undermines economic growth. But we got to tip one way or the other in the next few years. It's very hard to tell which way right now.
Okay, Hans, tell me, though, how are the people reacting or anticipating this bond buying program? I mean, how is that playing out among the populace?
Well, there's a great deal of concern among the Germans that this is going to lead to profligacy among some member states on the periphery, and by that they mean Greece, Spain, Italy. When you talk about the currency depreciation, or in this case depreciation in Switzerland and appreciation, but it's going to help the big businesses, the big exporters. I mean, 6-7 months ago, when the euro was close to 1.4, you couldn't find a captain of industry, you couldn't find a Fabrice Breger, the CEO of Airbus, that wasn't complaining about how difficult the high euro is making for them to be competitive. So for all the auto exporters, for Airbus, yes, for the Siemens of the world, at least so for some of their German businesses, having a weak currency, a weaker euro, is going to help the economy. In some ways, it's going to help the Germans a lot more than other countries, because Germans are so export reliant and their economy is so carefully levered and so carefully calibrated to exports. Betty?
I want to play for both of you, Larry Summers again at Davos, and what he was saying. Hans, a great point there about how the populace, the Germans, how themselves, they in many ways feel like they're lifting the entire eurozone. I want to play for you what Larry Summers said, though, about governments and how they should react to this, and what this ECB to be announced set of measures is going to do.
The era of central bank improvisation as the principal growth strategy has to come to an end if growth is going to be maintained and enhanced in the industrial world. It has to go way beyond the provision of liquidity if we are to avoid the fate of secular stagnation.
And, Mohamed, reminds me of your Bloomberg View column just a few days ago, where you said, look, the ECB, if they were judged just on execution alone, they'd get high marks, but they're going to be judged on the success, and that doesn't look promising.
Yeah, because they're not able to reach the four things that trouble Europe. They are not able to implement pro-growth structural reforms. They're not able to rebalance demand within the Eurozone. They're not able to lift excessive pockets of indebtedness. And they're not able to complete the economic union. So the ECB doesn't have the tools to address the fundamental aspects that are holding back growth. And therefore, they will not be able to deliver. That is a fundamental issue. And the irony here, Betty, is that people know that, and yet we still rely on the ECB.
Right, because there's nothing left, right? Mohamed, thank you so much. Mohamed El-Erian, our Bloomberg View columnist, and also former PIMCO CEO, and also to Hans Nichols, our international correspondent.